Balance of Payments, by Mohammed Zahir, www.trcb.me/Zahir. The balance of payments is a system of accounts that measures transactions of goods, services, income, and financial assets between domestic households, businesses, and governments and residents of the rest of the world during a specific time period. The statement divides international transactions into three accounts: the current account, the capital account, and the financial account. The current account deals with international trade in goods and services and with earnings on investments. The capital account consists of capital transfers in the acquisition and disposal of non-produced, non-financial assets. The financial account records transfers of financial capital and non-financial capital. The accounts are further divided into sub-accounts. Current account transactions, all payments and gifts that are related to the purchase or sale of both goods and services, pertaining to a period of less than a year constitute the current account in international trade. 1. Merchandise trade, exports and imports. The largest portion of any nation's balance of payments current accounts is typically the importing and exporting of merchandise goods. The balance of trade is defined as the difference between the value of merchandise exports and the value of merchandise imports. 2. Service exports and imports. The services exports and imports have to do with invisible or intangible items that are bought and sold, such as shipping, insurance, tourist expenditures, and banking services. Your article could be in this broadcast. Visit trcb.com to find out how. 3. Unilateral transfers are gifts to and from relatives and others abroad. Many governments grant gifts to and receive from foreign nations. Net unilateral transfer is the total amount of gifts given by United States minus the total amount received by United States from abroad. 4. Income receipts include income derived from ownership of assets, such as dividends on holdings of stock and interest on securities. 5. Balancing the current account. If the sum of net exports plus unilateral transfers plus net investment income exceeds zero, a current account surplus is said to exist. If the sum of net exports plus unilateral transfers plus net investment income is negative, a current account deficit is said to exist. Capital account transactions. Transactions consists of capital transfers in the acquisition and disposal of non-produced, non-financial assets for a period over a year. Broadly, these are divided into 1. Capital transfers include debt forgiveness and migrants transfers goods and financial assets accompanying migrants as they leave or enter the country. In addition, capital transfers include the transfer of title to fixed assets and the transfer of funds linked to the sale or acquisition of fixed assets, gift and inheritance taxes, death duties, uninsured damage to fixed assets, and legacies. 2. Acquisition and disposal of non-produced, non-financial assets represent the sales and purchases of non-produced assets, such as the rights to natural resources, and the sales and purchases of intangible assets, such as patents, copyrights, trademarks, franchises, and leases. The financial account. The financial account records trade in assets such as business firms, bonds, stocks, and real estate, and it has two categories. 1. U.S.-owned assets abroad are divided into official reserve assets, government assets, and private assets. These assets include gold, foreign currencies, foreign securities, reserve position in the International Monetary Fund, U.S. credits and other long-term assets, direct foreign investment, and U.S. claims reported by U.S. banks. 2. Foreign-owned assets in the United States are divided into foreign official assets and other foreign assets in the United States. These assets include U.S. government, agency, and corporate securities, direct investment, U.S. currency, and U.S. liabilities reported by U.S. banks. Balance of payments deficit and surplus. In theory, the current account should balance with the capital plus the financial accounts. The sum of the balance of payments statements should be zero. For example, when the United States buys more goods and services than it sells, a current account deficit, it must finance the difference by borrowing, or by selling more capital assets than it buys, a capital account surplus. A country with a persistent current account deficit is, therefore, effectively exchanging capital assets for goods and services. Large trade deficits mean that the country is borrowing from abroad. What affects the balance of payments? The balance of payments is affected by a country's rate of inflation relative to its trading partners and political stability. Political instability causes capital flight, moving assets to countries that are stable. Visit trcb.com for more great articles like this now.